Okay, well, good morning, everybody, and good evening to some of our speakers today on the podcast. I'd like to welcome you all to the Daily Energy Markets podcast, March the 9th. I'm delighted today to have three sort of analysts, I suppose, analysts and journalists with us. So we're going to have a lot of predictive insight, hopefully, given to us on the energy markets. Mr. Yousef El-Shamari, CEO and Head of Oil Research, Sea Markets, and Senior Research Fellow at Imperial College London. Saleh Yilmaz, Senior Equity Research Analyst for all things energy, oil, gas, transition, ESG at Bloomberg Intelligence, and Andy Critchlow, Head of News for EMEA at S&P Global Commodity Insights, who's joining us, Andy, from CERAWeek in Houston. So we're looking forward to hearing from you. And let's start with you, Andy. Let's start. You're still there in Houston. CERAWeek is still going. What's sort of been your top takeaway so far this week from your meetings and interactions with everyone there? Of course, following hot on the heels of IE Week in London. So,
yes, well, I think the Secretary General of OPEC, Haytham Al-Ghais, really kind of captured it for me when he spoke yesterday, and he talks about the so-called energy trilemma, this mixture of energy security, energy transition and affordability, which really cuts through the strategy that a lot of the leaders in the oil and gas space who are here convened in Houston, over 7,500 delegates attending CERAWeek this year, that they're grappling with this problem. And but he said there's something missing, and it should be the quadrilemma, not the trilemma, and that what needs to be added to this is energy reality. And I think that in between, the push for energy transition, the push to reduce emissions, the push towards net zero by 2050, what is sometimes lost, and this was the Secretary General's point, is that the global population will be close to 10 billion people by 2050, and that requires more energy, more commodities to sustain economic growth. And the fact is that with current technology as it stands at the moment, in his view, it's impossible to conceive of a world where you are not going to have hydrocarbons, you are not going to have oil, you're not going to have gas. We're going to need a mixture of all these energy sources and renewables, hydrogen, solar, wind, and we're going to need tremendous investment. And by OPEC's own estimates, oil and gas itself will require something like $12.1 trillion over that same period to produce the energy that the global economy will need. So, I think this was a really salient point for me that has come out from the debates and the conversations here is this need for energy reality. Yes, definitely the executives that I've spoken to here and what I've heard throughout the conferences that there is a huge push towards renewables, towards energy transition. However, there needs to be this energy reality check, and that we are going to need hydrocarbons. And the real concern is, where is the money going to come from to invest in these hydrocarbons and to sustain production through to 2045 and possibly beyond?
Yeah, and thanks, Andy, for that. And yes, the money, the investment, the decisions that these big NOCs and IOCs are having to take. Of course, they're carrying on with this parallel track to transition. But Yousef, let me go to you on that and talk to you about. Again, it depends on which producer you're talking about. Give us, from the perspective, Yousef, of the Gulf NOCs, let's say, or Gulf OPEC members. A few of them are spending a lot of money on the transition, but equally on ramping up their capacity of oil and gas as well. Yousef, how much of an issue do you think this investment scenario is for producers, whether in the Gulf or elsewhere, in terms of how they're allocating their resources to the trilemma, if you like?
Well, I think the investments issue has been staggering for some time, since I would say the the shale after the shale oil revolution back between, since in fact just close to the formation of OPEC plus. There's been a decline in the investments year after year, and this actually was kind of revealed given the recent gas crisis just before the Russian-Ukrainian war, end of 2021, when there was a less wind energy Eastern Europe, and then we see a sudden spike in gas prices. Of course, that led to a switch from gas to oil. It also led to oil going into the electric sector, something that hasn't happened for at least 10 years. And what that shows you is that the volatility in energy market has been quite high. I think here what we're currently seeing is there is a sort of I would say stability both in oil and gas markets, but that stability is temporary, and I think the markets continues to be very vulnerable. We have been able to get away with this winter with mild winter conditions, so that led to gas prices now going below $3. Also, oil is somehow stable, and in fact, even now the current inflation situation, the Fed is continuing to hike its interest rates over the next few months. In fact, by higher than what the market was previously expecting, and then we see continued pressure on oil prices as well.
Okay.
China is not coming. I think we, if the deteriorating, then here we need a shift in the policy. That is something important. We see some banks which are stopping funding new oil and gas projects, and I think if we do not see a major policy shift in the U.S. and in Europe, the issue I think will continue to escalate further and further.
Yeah. Okay. Well, thanks, Yusuf. And that policy, as you said, the policy of especially in the US, Biden has been sort of discouraging conventional oil and gas, encouraging energy transition investments, although last year they retracted a bit on that with the panic over high prices. Saleh, welcome again. Let's go to you on one of the points that Yusuf just touched on, which is prices and price projections going forward. A lot of people are saying sort of even the prices we're seeing today, which everyone is describing as reasonable and not too high, even those are not really being supported by a lack of supply or a certain scenario in supply. It's really just, panic over what's the Ukraine war going to bring. Where are we with the supply situation? Are some people correct who say that, we've got plenty of supply, no panic, and China demand is taking its time anyway, so we're fine for the time being?
Sure. So I think the important point to make here is that the curve for oil prices still remain very backwardated. And I think we need to remember that a lot of the producers, they really are operating at the back end of the curve. And when we have the back end of the curve still at relatively low prices, then this is one of the main reasons why perhaps the supply response that we've been expecting hasn't really been as big as some may have expected. In terms of supply, I mean, our outlook for this year is that there is some spare capacity, especially after OPEC Plus decided to bring back 2 million barrels a day worth of cuts back into the market. That's helped bring back some spare capacity. And I think on the demand side, because China went ahead with more lockdowns in the second half of last year, that's really helped the market remain in balance. When we look at the first quarter and potentially in the second quarter of this year, even though China is opening, which we expect to be gradual, we do expect enough supply, especially with that extra OPEC Plus spare capacity, to be able to meet that rising demand. When we look at the second half of the year, to the third quarter, fourth quarter, our balances suggest that we may actually be in a much bigger deficit than the first half of the year. And do we have enough supply to meet that kind of deficit? I think so for the second half of this year. But then beyond that, like once we exhaust a little bit more of that OPEC plus spare capacity, is there more non-OPEC supply coming online to meet that demand? A little bit, but then come end of year, next year, if we really do see demand proving to be resilient, and if we really do see, perhaps, I mean, China is a huge catalyst for demand. If we do see China get back on the pre-pandemic trend of just increasing, then I think we might be in a little bit more of a trouble in terms of really trying to see where that supply will come from. And, you know, even if we can find enough supply to keep markets relatively well balanced, I think we need to remember that the way oil markets work is if we really run out of any additional potential supply in the case of unexpected supply disruptions, that in itself could be enough to push prices, make the market very anxious. So again, on that supply picture.
Yeah, thanks, Saleh. I'll come back to you, and I want to talk a little bit about OPEC a bit more with you and Youssef. Andy, just on the point of China, from a CERAWeek perspective, is that a word that came up a lot? Not geopolitics, let's put that aside for today, but in terms of the demand picture, demand expectations, you know, was there consensus that, you know, it is not going back to 10% anytime soon on purpose? You know, that's its policy. And how hopeful are people that actually the second half of the year will bring, you know, some real sort of demand of energy pull into China?
Well, I think BP's chief economist Spencer Dale summed it up quite well today when he said, you know, China is the most important thing for the oil market this year, and what happens to the Chinese economy, especially in the second half, is going to be a defining moment for oil prices, and the supply demand balance as we go forward. You know, what we have seen is that the US really now as the marginal barrel, which has previously kicked in under different cycles at around $55 a barrel. You've had more production at that level. That has not happened.
And just to pick you on that point, Andy, while you're mentioning it, hasn't happened. And again, last year, everyone kept saying, why is it not happening? Prices were high. And it's not going to happen, right? I mean, essentially.
Yeah, I think that yeah, I mean, you know, the issue around production here in the US, and you know, again, this is the overwhelming thing that I'm hearing from delegates, is the cost of capital, the cost of debt, banks more reluctant to finance drillers across the full spectrum of production here in the US. And of course, you've got the Fed continuing to tighten interest rates. Those borrowing costs are going up. So, you know, I think the industry is still trying to, you know, peg a number on what that marginal barrel cost here is in the US. And of course, the US being such a major producer in terms of being able to balance the market there. And then the other side of this as well is, and we touched on this a little bit earlier, is the introduction of the Inflation Reduction Act here in the United States, and what that means across the whole energy spectrum. And it is incentivizing people in the industry to look at diverting more of their capital into areas that will attract subsidies from the US government. You know, $360 billion potentially of subsidies and incentives to invest in effectively renewable energy. So, okay, you know, is that going to be a drag on oil and gas here in the US going forward? But yeah, I think to come back to the point about China, it's the number one question that everyone is talking about here.
Okay, Youssef, just on the China thing, would you say that the second half of the year demand from China expectation has already been priced in to what we see today on prices? That's my first question to you. And are other producers, apart from the US, now accepting that, you know, OPEC, for example, they're the ones who are going to come up with any additional supply this year? We're not going to get it from the US. Has OPEC, the large producers there, accepted that, and are they ready for that?
Well, to a certain extent, I would expect prices to go higher in the second half of the year. So I don't think the Chinese demand is fully priced in. Yes, there is some optimism, yes, which is keeping a price somehow above $80. But I don't think that is fully priced in the current markets as we see it now. One major reason is the gas markets here, as the demand for gas is coming low, and this is a major reason why the oil prices continue to be much lower than what we expect them to be in the second half of this year. On the question of OPEC definitely they have spare capacity, especially Saudi Arabia and Emirates. I wouldn't be surprised if they ramp up production, but I don't think they will react to unsustainable signs of demand recovery. I think they need to be a real shortage in supply, and that will be shown by the inventories, including OECD inventories, and continued increase in Chinese deliveries. What we saw from Saudi Aramco, for instance, over the past few months is a continued rise in OSPs, official selling price, which tells you that OPEC, or especially Saudi Aramco, is expecting that there's an increased demand coming from the Asian markets. So I think there could be an increase in production in the second half of this year if prices can go up above $90 or so.
Okay, thanks, Yusuf. Saleh, on that point of Saudi OSPs obviously going up gradually over the last few months, let's talk a bit about Russian supply to China and to Asia, because of course, cheaper discounted Russian crude has been going to India, to China and other places. Do you see that as any impact from that on how OPEC will price its oil into Asia, first of all? And what is the viewpoint on the impact on Russian production generally in the second year of the war? We haven't mentioned it yet today. Are people really expecting it to be impacted more than it has been so far?
I think that's a really good question, and we really don't know. I think the market may have gotten a little bit complacent about how little disruption there has been to Russian supply, because I mean last year the street, I mean including ourselves, we really were expecting Russian supply to drop a lot more than it did. I mean, we were talking about perhaps around 1 million barrels per day, perhaps a little bit more earlier in the year. That hasn't happened, and as you mentioned, it's mainly because Russia was able to find other buyers for its crude. I mean, it had to sell at significant discounts, but nonetheless, the supply disruption that we were expecting just didn't really materialize, at all, really. But then again, with the new EU embargoes last December for crude and in February for Russian products, again, I mean, this is another catalyst where it could actually bring supply back. And then, as you know, a few weeks ago, we did hear Russia say that they might actually go ahead with 500,000 barrels per day of a retaliatory cut, just as a response to the European Union and the Western sanctions. So because Russian crude has been sold at a discount, this may have put some pressure on some of the OSPs from the Middle Eastern producers, but we haven't really seen much. I mean, as Yusuf mentioned, the OSP from Saudi Arabia for April was up again. I think what this is really signaling is that the demand they're seeing, perhaps from some of their customers, some of the refiners there, is positive, and I think it really is giving a bullish signal to the market about where the largest producer, largest exporter in the world is seeing where demand is going.
Andy, was there any talk this week in Houston about the sanctions in general, the impact of these sanctions on Russia? Obviously, we've seen how they've impacted trade flows, etc., of crude and now products. Was the industry pretty relaxed about that, given that oil has continued to flow, and that's kind of what matters, right? And what's the outlook for any further impact that might be expected from that?
Yeah, I mean, I'm picking up a sense of normalization here, almost. The industry has just accepted it and rolled on and adjusted. That said, the trade flows, and I think it's been alluded to already, in terms of shifting, crude into different markets. You have a huge swing of Russian production now heading into Asia. Obviously, that's putting pressure on Middle East producers. Middle East producers now looking for the first time in a long time into the European market to try and get market share back. We're going to see more US crude coming into the Atlantic Basin as a consequence of all this longer term. But yeah, I mean, Christophe Pouyanné from Total today in comment to the price cap, he said it's dangerous. When you start to interfere in markets overwhelmingly, most executives here that have spoken on the issue seem to don't like it when sanctions start to appear in markets. But the industry has adjusted, and there is this sort of sense of normalization about Russia and the situation there. There is certainly a sense that it isn't going away, that this is the new reality, the new world, and it's a world that the oil industry has to adjust to. And certainly from a policymaker's perspective here, we've had various US policymakers talking, obviously a number of OPEC ministers, etc. And it's clear that these sanctions have been designed to be porous. And that's the key thing. The price cap, it allows Russia to sell oil into the market. We haven't had that oil shock moment that we saw in the 1970s, for example, that we saw in the 1980s and other various periods in history. And that's designed. Now, is that sustainable long term? Well, I think the question comes back to the Russian government and Russian policy. Yes, they announced this 500,000 barrel a day cut. Have we really seen that materialize in the market? I'm not sure. Again, OPEC Secretary General, he did mention that they have seen a lot more Indian buyers, Chinese buyers taking Russian crude. They've seen Russian crude going into Turkey, for example. I think that everyone has seen these flows and tracked them.
And everything's being blended and re-exported, as you said.
Exactly.
No, I mean that flow certainly seems to be going. Let's just have a look at the poll question that just came up. More US rate hike plans will curb energy demand in the second half of the year. Agree or disagree? Yes, we've had the Fed this week again, sort of coming in and saying, "Oh, we're going to be the sort of higher for longer being repeated," but also we maybe got a bit higher. We saw what's happening with bond prices. That's surely going to impact company performance in general, obviously debt, corporate debt and everything else apart from government debt. Yusuf, let's first of all ask everyone to answer that question and whether it's going to curb demand. Yusuf, that's one question, isn't it? We've talked about supply now and we've talked about China demand, but even if China demand does materialize as expected and increases, we've got the balancing act there of the US and Europe supposedly going into recession because of these rate hikes, because of what we've seen last year play into. So how much is that being taken into account? 2 weeks ago, we had people saying there's going to be no recession. Now we're back to saying that that's coming. So from a sort of a policy supply point of view, how much would that impact things?
Well, I think that's why OPEC has been following a cautious approach. It just tells you the decision of making a 2 million barrels cut end of 2022 has been just coming at the right time. And another way, also in February, the JMMC, they recommended no change in the policy. And all of that, taking these factors that there could be that this year's economy may not be in its best conditions, especially because most analysts would expect a shallow recession, not really deep recession as what we saw back in 2020. So if that's going to impact energy demand in the US and in China and Europe, then I think OPEC, the cuts coming from OPEC will give an excellent support for the prices at the current time. I don't think there is a need to make any deeper cuts at this stage, even if the Fed continues to hike rates at much higher level than we are seeing now. So, but I think what we could see is no change in the policy until the end of 2023.
Okay, you say no change in policy, and OPEC has said that a few times or indicated that. Saleh, let me go to you with that. But however, if we do suddenly see a spike in demand or Russian production suddenly doesn't flow, because of logistics on the ground, we may need that sort of emergency supply from OPEC, Saleh. And of course, they have an agreement now on quotas and they're not planning to change it. But if they do, how much of an issue do you think that would be on the way up, if you like, in terms of increasing production? We saw some news, of course, with the UAE in the last week, reiterating its point about quotas. Clearly, it's not happy with how things are, and it wants to take advantage of any demand that might come.
So I think if they decided to start ramping up production in the beginning, it would be relatively easy because, as Yusuf mentioned as well, there is, notable spare capacity, especially in Saudi Arabia and the UAE, that can come back online. And I think especially UAE, I mean, currently they're producing just about 3 million barrels per day. Their capacity, according to the data that we have on the Bloomberg terminal, is about just about 4. So just the UAE has about 1 million barrels per day of spare capacity. And I think, they would be keen, I think, to be in a position to bring that back, because I mean, oil prices have come down, but they're still at a very favorable price point, and producing more would allow them to capture that good pricing environment a lot better. But very briefly, if I may, because we've done some analysis on recession and its potential impact on oil demand. So if I may, really quickly, so we looked at what happened to oil price whenever there was a recession in the US, and on average, actually, oil price went down by 30% in the 12 months following a recession in the US. And then we did the same analysis on the Bloomberg terminal, looking at what happened to oil demand after a recession. And the impact wasn't as certain. I mean, the oil demand doesn't really necessarily kind of slump in every recession. But I think the point there is that zero recession is usually enough to push prices higher. And arguably, this is what we've been seeing already in the last few months, that's really pushed down prices from the 3 digits that we saw to current levels. And sorry, I know that wasn't a question, but I thought that the report that we published recently was quite interesting.
Yeah, and as you said, sentiment, fear, that's been pushing things up and down. Andy, just back to you on that in terms of the sort of sentiment going forward. Was there any indication in Houston this week, or is there any indication that we may get back to triple-digit oil prices if that demand comes through, or if it does, it'll be controlled? OPEC will step in, do something about it.
Well, I mean, I've been going to big energy conferences now for over 20 years, and everyone that I've gone to at various points, someone will say we're heading for $100 oil. Whether it's an analyst, an economist, a strategist, an executive, an oil minister, no one's mentioned $100 oil. No one. And I think that says a lot. And I would, take that people are either very much on the fence. There's so much uncertainty, whether it's to do with Russia. Volatility has been a big factor in a lot of the discussions here. We talked about China. The points just made about the US economy and the impact of any potential recession, although I'm certainly not picking, kind of real fears of recession here up at this point. I think it's, but yeah, no one has mentioned that. No one's mentioned this, the fabled $100, kind of oil figure. I think it's interesting coming back to supply demand balances. You look at some of the plans in the Gulf that have been mentioned here. UAE going to 5 million barrels a day capacity, Saudi Arabia going to 13 million barrels a day capacity, Kuwait going to 4.5 million barrels a day capacity. The plans to get there, they're already in train. These projects are moving, and in the next 5 years they're going to get there, if not sooner. Where's that all going to go? So are we in a period in some time coming to towards the end of this decade where actually we have a lot of oil that is still trying to find a market, because there is so much uncertainty going forward over demand. The demand forecast long term, people seriously talking about peak oil. Does it come at 107 million barrels per day global market? Does it go, kick on much higher than that? And do we go through to 120, 130 million barrels per day through to 2045 and 2050. And then you come back to these big debates around providing energy and commodities for a population globally of about 10 billion people. Now, the big elephant in the room here, and what everyone is talking about, is the commitment to limit global heating to 1.5, 1.7 degrees increase.
Yeah, and that's not going to happen.
How that is, well, again, I spoke to Eric Vernes, chief economist at Equinor, for example, and he was adamant in the panel that I moderated here that's unachievable at the current trajectory. And so unless we see a dramatic shift in consumer patterns, and unless we see a dramatic shift in technology and investment into renewables, we're just not going to get there. So
yeah. They're already talking about the 2% now is the new target, basically.
Yeah, and these two things really kind of conflict. So you have these Gulf producers who are, these are huge plans to bring on more capacity. The industry and the rest of the world is not just going to suddenly disappear. Yet these climate change targets and these targets to get to net zero are still there. And it kind of comes back to this point about it's not an energy trilemma. There's four problems here, and I think the industry's become focused on getting rid of hydrocarbons, and that's not the problem. We need to get rid of the emissions.
Yeah, and that's a big topic of discussion, especially on the technology side. Well, we've run out of time. Thank you, Andrew Critchlow from Houston this week, from CERAWeek. Thanks for joining us and giving us the take there. Sara Yilmaz, thank you so much for joining us, and Yusuf El-Shamari. We got the survey question up. 73%, I believe that the second half demand will be impacted by further rate hikes from the Fed. So, the talk about recession and economies slowing down, at least in the West. We'll wait to see what happens on that front. Thank you so much, everyone, for joining us.
Thank you.
Thank you.
Thank you.